that this session will be recorded and will be uploaded to the GSAS YouTube channel. So if you would like to review any part of the presentation, you can go back and review that once it's been uploaded to YouTube. With that taken care of, I'm Sarah Hallberg. I'm a staff assistant here in the Office of Financial Aid. And on behalf of the Office of Financial Aid and the Graduate Student Council, welcome to the tax presentation. This presentation is intended for U.S. tax residents. So if you are an international student, we have another session coming up next week on Wednesday, the 28th at 12 p.m. That is going to be specifically for international students. So you may want to attend that session if that applies to you. If you have any questions during the presentation, you can go ahead and put them in the chat. The chat will be monitored and there will be opportunities to address those questions at the end of the presentation. So feel free to put your questions in the chat. And with that, I will turn it over to Zach, the president of the Graduate Student Council, and take it away, Zach.
Hello, welcome everyone. I won't take too much of your time. I just want to mention that this is part of the GSC's effort to provide programming to students on anything that might affect your success as a GSC student. We work with all kinds of people. We work with offices, like in this case, we're very lucky to be partnering with the Office of Financial Aid. We're also happy to partner with other student groups. And so let us know if there's any other programming that you'd like to see, and we'll be happy to try to arrange that. Also, we do have an attendance link with feedback. So if you click on the attendance link, we'll be able to assess how effective our programming is. And also there'll be more questions in there about other programming you might want us to organize.
I think we're good to go, Bob.
Okay, I'm sorry. I've got in the background my telephone ringing, and obviously someone doesn't realize no one's going to pick it up. But in any event, here we are. Welcome. I thank all of you, Rachel, Lisa, Zachary, and Sarah, for inviting me here. We've been doing these presentations for quite some time. Frankly, I wish they were. When I first started doing presentations about 8, 9, 10 years ago, they were in person, and I wish that was the case, but that's okay. We can get the job done through this media as well. So as you can see, we'll be doing a tax presentation, and at the bottom of this header sheet is this first page is my email address. There's a very good likelihood that at some point after this presentation, I suspect you may have a question. Feel free to send me an email. I respond to all of my emails as quickly as I can, usually within the same day, if not clearly the next day. And I'll certainly get back to you and respond to your question or questions that you might have. So feel free to use me as a resource, so to speak. But basically what we need to do here today is to introduce you to your responsibility, potentially, with regard to filing an income tax return, whether it be for the tax year 2022 or any future year for that matter. So pay close attention. Hopefully you'll pick up some helpful hints here and sort of eliminate the anxiety of filing an income tax return. It's not that difficult to process, and fortunately, with the tools that are available today, specifically the online tax services, specifically TurboTax, which is the most popular, you can get through the process fairly quickly. What we want to do today is point out some things that you need to keep in mind when and if the time comes you need to file an income tax return. So let's move to the next slide. And here's basically what we'll be going through. We'll talk about what your filing requirements are, reportable, what is included in your reportable income, some specific tax forms that will be used, possibly the need to pay estimated taxes, both federal and state government, and tax credits that are available. Student loan interest, if you're paying any, the deductibility of that, and then finally some state income tax information, and then lastly our Q&A, which we will continue until we complete answer everyone's question. So with that, basically, let's move to the next slide. And let's talk about filing requirements. Filing requirements basically in terms of those US citizens and resident alien taxpayers, you possibly have filing requirements with the US government, the federal government, that in particular, the department that is in charge of executing the tax laws in this country is the Internal Revenue Service. And there's quite a possibility that you may have to file a state income tax return. Of the 50 states, basically all but 9 have an income tax filing requirement potentially if your income exceeds the required thresholds. So basically, we have the thresholds here for 2022. These are the income tax thresholds requiring the filing of a federal income tax return. For state filing purposes, it varies from state to state. And we'll get into it specifically Massachusetts later in the presentation. So with regard to one's need to file a federal income tax return, there are certain thresholds that would require you to file an income tax return. If you're for 2022, if you're a single taxpayer under the age of 65, if you have income greater than $12,950, you would be required to file an income tax return. If your income was $12,951, you would pay a tax on $1. And just for your information purposes, the beginning tax rate for that $1 is 10%. So you would owe the federal government 10 cents, but the fact of the matter is, if you rounded these amounts, you would owe them nothing. But the beginning tax rate is at 10%. It then escalates, goes up to 12%, and it graduates all the way up to 37%. If you're a married taxpayer filing a joint return with your spouse and you're under age 65, the threshold is $25,900. And obviously, as you can see, the $12,950 for single taxpayer is doubled in this case, obviously, to cover 2 taxpayers in filing a joint return. So again, if your combined income of both individuals is greater than the $25,009, then you would be required to file a federal income tax return. The single and married filing jointly status is obviously the most popular, so to speak, in terms of individuals falling within either of those situations. If there's a case where you are married, you're filing separate returns for whatever the case may be, and you're under age 65, if your income is greater than $5, you are potentially required to file an income tax return. And it gets a little complicated with regard to married filing separately, because it's possible that both taxpayers would, although filing separately, would have a threshold of the single amount, which is $12,950. But I'm not going to get into that. I think for most of us here today, we're talking about filing either a single return or a joint return. There are other instances where the thresholds are greater or lower, as is in the case of a head of household. And basically, a head of household taxpayer is an individual who maintains a household for a dependent, whether it be a child or the parents of the taxpayer. In that case, the threshold is $19,400. And in those rare cases where you have a single taxpayer who is dependent of another taxpayer, if that single individual has unearned income of over $1,150 or earned income of over $12,950, they would be required to file an income tax return. So now keep in mind, it's possible that many of you over the years, maybe possibly while you were in high school or in undergrad school, it's possible that you may have worked a job And, a summer job, maybe, earned a couple of $1,000. You would be a single taxpayer in that case. And it's possible under the circumstances that you did not file a return because you maybe thought you didn't have to, or you didn't think about it, or whatever the case may be. But if you had that summer job and you worked and earned under the threshold, technically you wouldn't be required to file a return. But it's possible during those summer months of work, it's possible that your employer may have withheld federal and state income taxes. And if your employer withheld federal and state income taxes, and if you weren't required to file a return, you would be entitled to a refund of those taxes. The problem is this: the government's not going to initiate sending you that refund. And if you probably realize that by now, because you never got any type of refund back. The only way you're going to get that money back is to file a return. So you would file a return, you would report the income, you would show that it's under the threshold, and you'll see what I'm talking about in a little bit, and basically ask that federal tax. Again, let's say you worked, made a couple of $1,000. Your employer might have taken a couple of $100 out of that $2,000. That $2,000 is yours, but the only way you're going to get it back is to file a return. So keep that in mind. If you've had a couple of those summer jobs and you still have maybe the tax form that you receive from your employer, the W-2 form, then I would suggest that you go ahead and file a return. Unfortunately, the door will close on you, and the door closes typically after a 3-year statute passes. So if there's a return that you should have filed for 2018, that return should have been filed by April of 2022. You've missed the boat, so to speak. So if there's a 2019 return or a 2020 return that you could file to get that money back, I would suggest you do that right away so that you will get that back. So just keep that in mind from a standpoint of filing a return. All right, so now let's move on to the next screen. And let's bring to your attention what is known as the kiddie tax. Basically, a number of years back, the Congress, the IRS, the Congress at the prompting of the IRS basically brought to their attention the fact that a lot of taxpayers are sheltering income by giving it the asset that's generating this income to a child under the age of 18. And basically what happens is, even though that child may possibly have to file an income tax return, a parent may be in a 37% tax bracket or even higher, and the child may be in a 10% tax bracket. So it would behoove the parent to sort of shift that income in some shape, manner, or form to the child to pay a lower overall income tax. Well, they got wind of that, and basically the so-called kiddie tax was initiated back several years. And basically what it's attempting to do is tax the income of a child at the parent's tax rate. So there's some rules here what we have to follow, and let's just go starting at the top. This particular kiddie tax applies to children under the age of 18 and certain children described below with unearned income of over $2,300. So for example, when we talk about unearned income, we talk about dividends, we talk about interest, but we also have to add to that mix other unearned income. And that other unearned income, which we will talk about momentarily, is potentially the taxable income that you may be receiving from the university in the form of a monthly stipend. So we'll get into that. That is considered unearned income. So if you have interest income, dividend income, or a amount of stipend that you have to report, it's possible if you meet the following criteria, it's possible that that income is subject to the kiddie tax. So who must file? Now, the form 8615 is a tax form that accompanies your income tax return. So basically, you must file Form 8615 if all of the following conditions are met. There are 5 that would apply. The child has more than $2,300 of unearned income, dividends, interest, or a stipend income that has to be reported. The child is required to file a tax return. So if you've exceeded the thresholds that are required to file a tax return, the child was either A, was under the age of 18 at the end of 2022, B, was age 18 at the end of 2022 and did not have earned income that was more than half of the child's support, and I'll elaborate that in a moment, and C, was a full-time student at least the age of 19 and under age 24 at the end of 2022 and didn't have the same unearned income that was more than half the child's support. Number 4, at least one of the child's parents was alive at the end of 2022. And then lastly, 5, the child doesn't file a joint return for 2022. So if the child is married in 2022, before the end of 2022, you would be ruled out from having to file this particular tax form 8615. Now, going back to 3B and 3C, basically what they're saying there is this: if you've had enough earned income, let's say wages, salaries from employment, that was significant enough to be more than half of your own support. In other words, you're supporting yourself. Then this tax, the filing of Form 8615 in the underlying tax would not apply to you. So in either of those cases, if you're working and earning enough income to be sufficient to support yourself, then this wouldn't apply. So these are all the rules that would apply to the need for you to file the Form 8615 and accompany your income tax return. Now, at the end of the day, for most of you, if not all of you, you're going to use some sort of tax software. And the fact of the matter is, for example, like I said, the most popular tax software, if you're not familiar with it, you will soon become familiar with it, is TurboTax. And TurboTax is a very, very, very good product, an excellent product. And certainly by you going through the process of using that product to prepare your return, and respond appropriately. Obviously, the tax software that's out there for at-home use, so to speak, is designed to help you arrive at, obviously, the preparation of an accurate income tax return. The key to all of that is being able to respond correctly to the menu, the many, many questions that will be asked of you when preparing the return. So at some point along the way in preparing your return, there will probably be some questions that would prompt you to respond to determine, so that the software can determine if this particular tax applies to you. So be very careful. It can be somewhat tedious in terms of preparing your return using this software products, but basically every question is very, very important in allowing for you to prepare a complete and accurate return. So keep that in mind. The other thing you have to keep in mind is if in fact the kiddie tax does apply to you, you will need to sort of coordinate this whole filing process with your parents because, again, as I stated earlier, the kiddie tax is a calculation which results in the taxation of this unearned income at your parents' tax rate. And obviously, the only way that the tax software is going to know your parents' tax rate is obviously the need for you to, again, reach out to your parents with regard to this possibility so that they can provide you with the appropriate information. And maybe even better still, if the tax does apply, maybe you can get your parents or your parents' tax return preparer to prepare your return for you and eliminate all of this confusion. So keep this in mind. If you feel that you fall within those 5 conditions, then keep this in mind is in terms of being a possibility for you in your particular case at this point in time. All right, enough said. Let's move on to the next slide. All right, to continue the filing requirements, if you happen to be a non-resident taxpayer, in other words, if you're not a US citizen or a resident alien, who has a green card or passes this so-called substantial presence test, then you would be considered a non-resident taxpayer and would have to file Form 1040-NR. And as it was stated earlier, a week from today, there will be a presentation for those international students to address their filing requirements. So if, again, that applies to you, join us next week at 12 p.m. Same day, and we'll go through the process to help you in that regard. So, all right, now filing options. Basically, what we're talking about here, you got 1 or 2 options. Basically, you can file electronically, which more and more people every year are filing electronically. And with regard to this pandemic that we just went through, it was best that you do file electronically. It's possible that you've heard in the news that the IRS was behind in terms of processing millions upon millions of paper returns. And if you filed a paper income tax return and you were due a refund, it's very likely you may not have received your refund yet because those paper returns have not been processed. They're trying desperately to catch up. But my understanding, I got a call the other day from a client of mine who filed a 2020 return, waiting for a pretty significant refund, finally just received their refund. So if you can file electronically, by all means, I would suggest that you file electronically, because obviously filing electronically, your data goes directly into the Internal Revenue Service computers, as well as all of the states. All of the states now are accepting electronic filed returns. So obviously with that, the return gets processed more quickly. And obviously, if you're entitled to a refund, you're going to get it back much more quickly. So keep that in mind. There are rare occasions where you would have to file a paper return. Most every taxpayer today, both resident and non-resident taxpayers, can file electronically. There are a number of options out there. There's a link there that I provided where you can file, go to the Internal Revenue Service website. The Internal Revenue Service is irs.gov. Very helpful for a host of reasons. And there is a link in there where you can file your return for free. And as I indicated, the threshold there for filing a free return, if your taxable income is under $69,000, which for many, if not all of you, would be the case, you can file a return for free. So keep that in mind. In the state, there are various options available to file state returns, either for a minimal fee or no fee, no cost to you. For example, my understanding with regard to TurboTax obviously, once The one thing about all of this, I'm dealing with it in my own business, so to speak, the professional tax software that I use, I've been using for several years now, and it's very sophisticated. And obviously, I have become so accustomed to it. For me to go to another tax service would sort of be kind of insane, because I then have to go through the learning process of using that new software. So I'm kind of stuck with the software that I have, which I'm very happy with. I suspect I could probably get a much cheaper professional version by some other vendor who wants to take me away from my current vendor. But basically, I just don't have the time or the energy to sort of have to worry about jumping ship and having to learn the whole process over again. And that's the case with TurboTax. TurboTax, as I understand it, offers the federal version of the tax software free of charge. Where they sort of kind of get you, I guess, is if you have to file a state return. And my understanding is they charge you for the processing or the use of the software for preparation of your state return. So obviously, what they're hoping to do in terms of from a marketing standpoint is, of course, sort of get you hooked on the use of the product, and you'll be a customer for the next 40, 50 years that you have to file an income tax return. So, look around. There are many options out there in terms of filing federal or state returns, and use the one that you feel most comfortable with. So, all right, having said that, let's turn to the next slide. Let's just briefly talk about reportable income. What is reportable income? Basically, the Internal Revenue Service, the taxes are governed by the tax code. There is a tax code. It's called the Internal Revenue Code. And basically, when we talk about reportable income, there is a section of the tax code which is called Section 61 of the Internal Revenue Code. And basically, it says income from whatever, all income from whatever source derived is taxable. It's reportable. And some of this income that we're familiar with is the fact of maybe salaries or wages. Again, you have that summer job or a full-time job, and you're being paid a salary or a wage. And come the end of the year, your employer will issue you a W-2 form, an example of which you'll be seeing shortly. So you work for a company, at the end of the year, you get this report, this form, W-2 form, basically informing you, and not only you, but also the Internal Revenue Service. The IRS is going to get a copy of that W-2 form. And although we have a voluntary tax system, the government is also going to get a copy of that W-2 form, and it's going to, at some point, not immediately when you file your return, but at some point later down the road, after your return has been filed, the Internal Revenue Service is going to compare the W-2 form that they received versus what you've reported on your tax return. So it's a bit of a check and balance. And basically, I recently, what has been discussed recently is a time where it's possible the federal government is going to send you a copy of what they believe your tax return should look like for your signature and filing. So in other words, as more and more of this information becomes available to the Internal Revenue Service, it may possibly get to a point where a return will be sent to you, probably electronically, for your verification and signature. And that will be the process that people may go through in terms of filing their returns at some future date. So again, the W-2 is an information return form that you'll receive. Other information forms that you might receive would include 1099 forms, where a bank or a financial institution would report not only to you, but to the Internal Revenue Service, any interest that you may have earned on a bank account or any dividends that you may have earned on stocks. Other forms of taxable income come in the form of the financial aid and support that you might get through the university. And we'll get into that in greater detail in just a moment. But basically, that possibly some portion of the financial aid you're receiving will be taxable. The bank interest and dividends, as I mentioned, if you have other investment income, that would be considered reportable and taxable on your return. If you receive royalties, if you win any prizes or rewards, those amounts be reported as well. And if you have any dealings in real estate, whether it be rental of real estate or the sale of real estate, that would be reported on your income tax return as well. All right, let's move on. Next slide. All right, let's talk about fellowships, scholarships, and grants. Basically, I want to refer you to make a note of this. The Internal Revenue Service has a publication. It's publication 970. And publication 970 is helpful in the sense that it discusses the taxation of scholarships, fellowships, grants, and awards. So you can go to the Internal Revenue Service website, irs.gov. You can do a search for publication 970, and you can download it in the form of a PDF file. And I believe it's chapter 1 of the publication goes into depth with regard to the taxation of scholarships and fellowships. So basically, the IRS defines scholarships as generally an amount paid or allowed to a student at an educational institution for the purpose of study. So you get a scholarship. That scholarship is going to help with you with regard to maybe all or a portion of the tuition and fees that are required of the university. If you receive a fellowship, generally that amount is paid to an individual for the purpose of doing research. As I state here, whether it's identified as a scholarship, fellowship, grant, or award, taxation of such is controlled by Section 61, which I mentioned earlier, and Section 117 of the Internal Revenue Code. As you can see there, Section 61 in the Internal Revenue Code states that, except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including but not limited to the following items. So basically, the tax code says your income is all income from whatever source derived. So you can receive income from all sorts of directions, so to speak. And the tax code is simply saying, all right, if you receive income from here, or income from there, or income from any source, it's taxable. So we start there. But the tax code then goes on. It has numerous other sections that are specific in terms of what can be excluded. So the one section that applies to scholarships and fellowships is Section 117. And Section 117 indicates that gross income does not include, and that's what we like to hear, because obviously if it doesn't include, we don't have to report it, we don't have to pay taxes on it. So gross income does not include any amount received as a qualified scholarship, which we'll talk about momentarily, by an individual who is a candidate for a degree at an educational organization. So I would suspect that all of you listening here today are individuals who are candidates for degree at an educational institution, namely Harvard University. So we sort of meet all of that. So if any of your scholarships, fellowships, awards, or what have you are for that purpose, then are qualified scholarships, then that portion of the aid that you've received is not taxable. So let's go to the next slide. There we go. All right, taxable versus non-taxable. So this aid, this support, this financial aid that you're receiving is non-taxable if the following conditions are met. The individual is a candidate, as I stated earlier, for a degree at an educational institution that maintains a regular faculty and curriculum and normally has a regular enrolled body of students in attendance at a place where it carries on its educational activity. No question, Harvard University clearly meets this criteria. And secondly, amounts you receive as a scholarship or fellowship grant are used for tuition and fees required for enrollment or attendance at the educational institution, or for fees for books, books, supplies, and equipment required for courses at the educational institution. These are known as qualified educational expenses. So if the aid and support that you're receiving is for qualified educational expenses, that portion of your support that you're receiving is not taxable. And in the case of Harvard and in many other financial institutions, the fact of the matter is that aid that you're receiving that is for qualified educational expenses, you typically don't see it, feel it, touch it, or have access to it. Basically, the university will send you, or you have access to, some type of accounting. And when I say they on that accounting, they'll show the tuition, they'll show the fees, and then on that accounting, you'll see those amounts being offset by your financial aid. So you don't even see those funds, or you don't have access to those funds in terms of utilizing those for anything other than qualified educational expenses. So therefore, if you're receiving any type of support or financial aid that you are using for incidental expenses, which is the next component, then what is taxable, if amounts are used for incidental expenses such as room and board. Now, my understanding is the university is paying many of you a monthly stipend. And that monthly stipend, again, as I understand, is for your use in terms of meeting your needs with regard to providing yourself with room and board. And it goes beyond just room and board. If these amounts for incidental expenses such as room and board, travel, optional equipment, and generally amounts received as payments for teaching, research, or other services required as a condition for receiving the scholarship or grant, fellowship grant. In addition, any part of the scholarship or fellowship that represent a payment for services is taxable. So if you're receiving some type of what is deemed to be support because you're providing services, then that amount is taxable. So you want, and typically, if you are receiving an amount for services that is taxable, you will get from the university a W-2 form as though you're an employee. So basically, what it boils down to, for the most part, and for most of you, that monthly stipend that you're receiving is going to be taxable and reportable on your individual income tax return. All right, next slide. As I stated earlier, basically what you want to do is refer to that publication. It would be helpful to go through that process. And there is also within that chapter of that publication, a worksheet that you can use to help you arrive at what would be taxable or a scholarship or fellowship income. Now, as I stated earlier, basically to sort of keep everybody honest, there are different reporting mechanisms used by the IRS that are required by the IRS to report income to the IRS and also to the taxpayer. There's the W-2 form, there's a various form 1099s. If you're a non-resident alien and you have income that you're receiving, that would be reported to you on a form 1042S. And there are instances where you have income, but there is no form that is being filed with the IRS or provided to you to identify that income. And specifically what I'm talking about is this stipend. The financial aid that you're getting from the university there is no reporting mechanism required by the Internal Revenue Service that the university, report to the Internal Revenue Service. So basically, I suspect over the years, there've been many graduate students who has received a taxable stipend, who in fact may not have reported that as income. Again, because there is no check and balance, so to speak, with regard to notifying the IRS that this particular taxpayer has received taxable income. Our tax system is such that it's a voluntary system. And you are required to report all of your income from whatever source derived, whether you receive any type of tax document or none whatsoever. So just keep that in mind from that standpoint. Now, at the bottom here, basically, if you do have to report a portion of your financial aid on an income tax return, basically, and we'll see this again, I'm showing this here in this slide and in a subsequent slide, but basically on line 1 of Form 1040, your federal income tax form, is where you enter your wages, salaries, tips, etc., on your tax return. And as you'll see, there is a notation labeled SCH. And in box 1 of that tax form, again, we'll see this again in another example, is the amount. Now, basically what this is telling the IRS is this, that on line 1, some or all of the amount on line 1 is a taxable scholarship or fellowship amount. So that's how it's reported. And again, if you're using a tax software that if you're using tax software such as TurboTax, if entered correctly into the tax software, this notation SCH should show up to the left of box 1 of the tax return. If you've entered it incorrectly and this does not show up, then you've done something wrong. And again, I'm going to talk about this again on a further slide. All right, let's bring to your attention a couple of tax forms that you need to be familiar with. So let's go to the next slide. All right, what we have here is a rather dated W-2 form, but the fact of the matter is a W-2 form. This one is for tax year 2019. And the fact of the matter is the W-2 form issued by the university to this very day looks very much the same, except for the fact that obviously the year is different on the form itself. So here's an example of a W-2 form that you would receive from your employer. So in this case, we have the taxpayer receiving in box 1. I know it's a bit difficult. I should blow this up a bit, but basically, box 1 of the W-2 form is the wages that were earned by the individual of roughly $44,000. Box 2 of the W-2 form indicates the amount of federal income tax withheld from those wages, and then down on box 17 is the amount of state income taxes withheld from these wages. So W-2 forms come in many shapes, sizes, and colors, but basically they all have the requisite information on it in those 20 boxes. So the format and layout of the forms from one employer to the next may be different, but at the end of the day, you have line 1, box 1, which is the wages, box 2, which is the federal income tax withheld, and so on, which is going to be similar from one W-2 to the next. So if you have been employed during the year, whether it be a part-time job, whether it be through the university or outside of the university, you should anticipate receiving a W-2 form. If you don't receive a W-2 form and you believe you should have received one, then I would obviously pick up the phone and contact that employer and ask them why they have not issued a W-2 form. Now, basically, for tax purposes, we are all taxpayers operating on a calendar year. What that means, of course, is the tax year starts on January 1st. It ends on December 31st. So all employers are required to issue these W-2 forms generally by the end of January. Sometimes they go a little later into February, but basically come the end of January in the following year. So for the 2022 tax year, by the end of January of 2023, you should have received your W-2 form. So keep an eye out for it if you believe you should be receiving one. And if not, follow up so that you can get the appropriate form from your employer or employers. All right, next slide. All right, what we have here is, again, a dated income tax form. This is Form 1040, U.S. Individual Income Tax Return, and this is for the tax year 2019. The layout of it is pretty much the same at the current time, basically. Few modifications, but the fact of the matter is, if you were to look at a 2022 or 2021 income tax form, they're pretty much the same. Now, as I demonstrated in the previous slide, an earlier slide, I'm demonstrating here that John Doe on line 1 of Form 1040 has an amount of $33,600. And to the left of that, we have that SCH, and what, again, as I stated earlier, that's indicating that some or all of that amount is a taxable scholarship or fellowship. There's also a reference there, which I haven't included. There is a statement that would accompany this Form 1040 detailing what that $33,600 consists of. So for example, let's say this individual worked, had a job, received the W-2 form, and on that W-2 form was $10,000 of wages. Then that would mean that this individual not only had $10,000 of wages, but this individual has $23,600 of taxable scholarships and fellowships. So the amounts are combined on line 1, the wages that they might earn plus the taxable scholarships and fellowships. And if you referred to, again, that statement 1, which would have been attached to this physical return, that detail would be represented there. Now, there are other lines on this tax form, as you can see: dividend income, interest income, pensions, Social Security, capital gains, so on and so forth. Well, this taxpayer, the only income this taxpayer has is that $33,600. And this taxpayer is a single taxpayer. And as you can see on line 9, there's an entry there, and that line 9 entry is $12,200. Now, if you recall earlier, there are certain thresholds that one needs to exceed that would require you to file an income tax return. Back in 2019, that threshold for a single taxpayer was $12,200. And if we refer back to that earlier slide, which we don't have to, if you recall, the threshold for 2022 is $12,950. So if this were a 2022 income tax return, instead of you seeing $12,200, you would see $12,950. Now that $12,950 is referred to as your standard deduction as a single taxpayer. If you were married, that deduction would be twice that on line 9. And as you can see, the mechanics of this tax form is that that $12,200 is carried down to line 11A, and then a line 11A is subtracted from the $33,600. What remains is what is known as on line 11B, your taxable income. This is your taxable income that you're reporting to the IRS, and this is what your income is and what your tax will be based on. And if we flip to the next slide, we'll see that amount. So back in 2019, the tax on $21,700, and I get it right, no, I'm sorry, $21,400 is $2,377, just slightly over 10%, which is the first tax bracket for income taxes, for federal income taxes. So this taxpayer's tax obligation is $2,377 on taxable income of $21,400. Now, just for, I didn't demonstrate it in an additional slide, but basically, for example, and someone might correct me if my understanding that the typical stipend for this school year is roughly $3,385. If I'm incorrect, please jump in. Now, if you're a first-year graduate student, I believe again, and correct me if I'm wrong, if you're a first-year graduate student, you'll begin receiving that stipend, if I'm not mistaken, in August. And that will continue through the end of the year. And if that's the case, you would be receiving a total of 5 monthly installments, payments, which would total $16,925. We then subtract that standard deduction of $12,950 to arrive at a taxable income of $3,975, and your tax would be $398 for this initial year. If, for example, you're receiving that full stipend amount for a 12-month period of time, that would total roughly $40,000. Your taxable income would be roughly $28,000, and your tax on a full year's worth of taxable stipend would be in the neighborhood, your federal tax would be in the neighborhood of roughly $3,200. So that's going to give you some idea with regard to what you may be looking at with regard to the 2022 tax year. So having said that, one last thing I want to bring to your attention with regard to this particular slide, you have that red arrow there, which is sort of aimed at lines 21A through D. On this particular section here of the return allows you the opportunity to identify a bank account that you would like your refund deposited to. So if you file your return electronically, and if you are receiving a federal income tax refund, and this goes for the state return as well, if you have a state return you have to file, you can designate a specific bank account where you want that refund deposited, and it will go directly to your bank account. Very good idea, obviously, to speed up the process. And in good times in the past, the filing of an electronic federal income tax return with the direct deposit option initiated, you could get your refund back within a matter of a week to 10 days. So obviously it speeds up the process and so forth. But more importantly, it's possible that because of where you may be logistically, in terms of your address, where you may physically be, it's possible that if you were waiting for the government to send you a check, that check may end up somewhere other than where you may physically be. So obviously, if you have a bank account, I would highly recommend that you use direct deposit feature. All right, let's move on. All right, now, again, if you have a source of financial aid, scholarship, fellowship, what have you, that you're receiving, the university is not required, that stipend is not required to withhold income taxes. So the next question is, well, if they don't withhold income taxes, how do I pay my taxes? Well, you would be responsible to pay them on your own. So at the opening sentence of this slide, basically, For federal and state income tax purposes, all taxpayers who expect to owe $1,000 and $400 respectively are required to pay an estimated tax. So you have to voluntarily, at specific dates during the calendar year, send the government what you believe to be your estimated tax. Those dates happen to be April 15th, June 15th, September 15th, and then the following January 15th. So if in the calendar year 2022, you were required to pay an estimated tax, your first installment would have been due April 15th, the second installment, June 15th, and so on. Now, those of you who that are first-year graduate students and would be receiving sort of an abbreviated amount of stipend, your tax liability is under, for federal tax purposes, is under $1,000. So you were not required to pay an estimated tax because your expected estimated tax is going to be under that threshold. Now, be responsible to fully pay what you owe come April 15th when you file your April 15th of 23, when you file your 22 income tax return. And we can get into that in a little greater detail. But basically, if you anticipate, and those of you who have or will in the following tax year receive a full year's worth of taxable stipend, your tax liability, as I stated earlier, is going to be slightly over $3,000. You would be required to file a quarterly estimated tax, and in that case, of roughly $750 per quarter. Obviously, 4 quarters times 750 would equal that $3,000 that you would owe the government. So come the time you physically file your return, you will be paid, virtually will be paid in full and have nothing to worry about. And that's the approach you should take, frankly. I would not wait till the 11th hour. I would stay ahead of it. I would stay on top of it so that you don't have any surprises come the filing date of your return. So to reiterate, basically, again, your returns are for a calendar year. So for the calendar year 2022, your return is due on April 15th of 2023. So keep that in mind in terms of these particular dates that are very important, okay? Now, as far as paying the estimated tax, you can do it one of two ways. You can do it by either paying it electronically, which I'm sure most of you will if you have to, or you can certainly send them a check. I have at the bottom of the page here put a couple of links with regard to the payment of the federal amount. If you go to that, you will then enter in the amount, your Social Security number, and your banking information, and you will process the payment through that avenue. The same applies to the state of Massachusetts. And if you had an obligation that you owe to any other state, the fact is every other state has some type of online link that you can use to pay your taxes. If you decide that you don't feel comfortable in paying them electronically, send them a check. If you do send them a check, you need to send with that check a payment voucher. For federal tax purposes, the payment voucher, the form number of the payment voucher is Form 1040 ES, Edward Stephen. And for Massachusetts purposes, the form number is M1-ES that you would use. And basically the form, it's just simply like a transmittal form, which has your name, Social Security number, and the amount, so that when they receive that check, they can specifically identify it as being paid, sent from you, and apply to your account. All right, let's move on. There are some tax credits that you may be able to take advantage of. We'll get through these next few slides fairly quickly so that we can get into our questions. But basically, there are some tax credits that are available. The one that could possibly be available to you is the second one there that I have listed, the Lifetime Learning Credit. The first one, American Opportunity Credit, is essentially available for undergraduate students and not a student who is in graduate school. The Lifetime Learning Credit is available to all, and it's based upon you incurring qualified educational expenses for our higher education. Those qualified educational expenses include tuition and related fees required for enrollment. It doesn't include room and board, so basically tuition and fees. The maximum credit is $2,000. And the $2,000 credit, when I talk about a credit, what I mean is it's dollar for dollar reduction of your income tax. So if you're a taxpayer and you owe $3,000 in federal taxes, and this tax credit is available to you, you no longer owe the government $3,000. It would be offset by this tax credit of $2,000. And basically, the credit is no greater than $2,000, provided you incur qualified educational expenses of $10,000. Now, those qualified educational expenses have to come out of your pocket. If those qualified educational expenses were paid for by fellowships and scholarships, then that portion of the qualified educational expenses deemed to be qualified educational expenses. Again, these are amounts that you pay out of pocket. This credit gets phased out. So for example, if you are a single taxpayer and you have income over $90,000, you can't take advantage of the credit. And if you're a married taxpayer and have income over $180,000, the credit is not available to you. So it's something that may be available to you. Again, if you're using a tax software like TurboTax, you can go through the exercise to see if in fact you do qualify. Next slide. If you are paying any student loan interest on loans that you've taken out to help pay for your education, grad for that matter, you can deduct, this is woefully a low amount, but basically right now the tax code basically will allow a student loan interest deduction of $2,500 or less if you paid interest on a student loan during the course of the year. You know, the deduction itself only saves the amount of tax depending upon what tax bracket you're in. So if you're in a 10% tax bracket and you've paid a full $2,500 interest on your student loan, the tax saving is only going to be $250. So it's not such a good deal. Fortunately, with obviously some recent legislation that has occurred, the federal government is beginning to obviously forgive certain student loans. So that would certainly be much greater help than this tax credit, but this deduction. So keep this in mind. Again, the tax software will help you to determine if the deduction is available to you. As you can see, it gets phased out if you're married at $175,000 or if you're single at $85,000. So keep that in mind. All right, next slide. All right, just to talk briefly about Massachusetts in terms of your requirement to file a Massachusetts return. For Massachusetts state income tax, you are deemed a full year resident if you maintain a permanent place of abode in Massachusetts and you spend more than 183 days of the taxable year in Massachusetts. For those of you who are just arriving here in Massachusetts come this past August, you will not be physically in Massachusetts for more than 183 days. Therefore, you're not a resident. And if you don't have any Massachusetts source income, you don't have any Mass income taxes to pay. So there's a very good likelihood that you do not. And if you're not a resident, then any taxable stipend is not, it would not be income on a Massachusetts return, because if you don't maintain a permanent place of abode. And when we talk about a permanent place of abode, if, for example, you're in university provided housing or a dorm, that is not deemed to be a permanent place of abode. So it's likely that at least your first year here in Massachusetts, you don't have to file a Massachusetts income tax return. So just keep that in mind. And again, if you're using, excuse me, the tax software, it will help you get through that process as well. Excuse me. All right, next slide. Permanent place of abode, just to reiterate with regard to that, depends on, again, I'm just sort of reciting what I just basically said. If, for example, you're in campus housing and that would be considered dormitory and it would not be considered permanent place of abode. If, for example, you're in a rental apartment that you've rented for your stay here at the university, then that would consider to be a permanent place of abode, and that plays into whether you become a Mass resident and the need to file a Massachusetts return. So keep all of that in mind. And then lastly, the final slide, other states, it's possible that you may be coming in from another state. And yeah, if we can go to the next slide, please. It's possible that you may be coming in from another state where you may have worked, and it's possible that you may have to file not only a state return from where you originated from, so to speak, because of employment. It's possible you may have to file what would be a resident return or a part year resident return for that period of time that you were in another state, and possibly a part year return in Massachusetts. So keep that in mind. Again, the tax software is going to help you with that in terms of what state returns you may need to file. So having said that, let's get to the chat and answer all of your questions and more.
All right. Don't have a lot of questions so far. Some of them I think may have already been covered in the slides, but we'll run through them. One question was, does TurboTax still have a free option? What other free software do you recommend? And there's a link to the department, the IRS has a free list of free software that you can file.
Yeah, so you would want to do that. And obviously you do a Google search, you're going to get inundated with options as well. You know, going to the IRS site, you do these Google searches, you never know where you may land. Obviously, the option through the IRS site, it's obviously going to be a valid source that you might want to use. So, keep that in mind always, because if you're preparing a tax return, you're providing whoever you're providing with some vital information, namely your name, address, social security number, date of birth, and all of that. And that obviously, if it gets into the wrong hands, needless to say, it could be a problem. So just be careful in that respect.
A couple of questions about estimated taxes that I think were covered, but just in case, what is the general rule of thumb percentage for PhD students receiving a 38 to 41K stipend that we should be putting aside since it isn't deducted automatically? What percentage of our stipend should we be saving each month? Just a ballpark.
Yeah, again, as I stated earlier in my example, and I should probably include a physical calculation within the slide, but basically for 2022, if you've got roughly $40,000 of taxable income, I'm sorry, $40,000 of income you have to report, after your standard deduction of roughly $12,950 as a single taxpayer, your taxable income is roughly $28,000. The tax on $28,000 is just slightly over $3,000 federal. And what does that translate into? Roughly about $750 a quarter. So on $40,000, you're talking, what percentage is that? I'm not very good without a calculator, but basically $4,000. Yeah, well, roughly in their case, roughly, I would say as a rule of thumb, 10% of what you're receiving, to set aside 10% of what you're receiving is going to cover your federal tax liability.
Great,
So
okay,
keep that in mind.
I think that's helpful. I'm wondering if or how getting income from an external funding source like NSF affects taxes. I think we covered that all of your external funding sources, whether it's a Harvard funding source or the NSF money, that is considered taxable income, correct?
Would it be the NSF income? Well, again, it all boils down to when we talk about what it's used for. If it's used for qualified educational expenses, then I would say it wouldn't be taxable. If it's sort of discretionary, like the typical Harvard stipend, then it would be taxable. So I'm not fully in tune with regard to the uses of all of these outside funding sources. But again, if you go to that publication 970, there is a discussion of that, but that discussion is basically, as you've just presented this particular slide. When we're talking about the taxability and non-taxability, it really, the difference lies in, is it for the payment of qualified educational expenses? If it is, then I would say it's clearly non-taxable. If it's used for anything else, it's taxable.
Okay, great. Couple questions about state taxes. So one question was filing jointly. The student is here in Massachusetts, the spouse is in New York, and they both have income from the state of New York and the state of Massachusetts, respectively to where they're located.
Yeah.
What is the best way for them to file? Do they both need to, because they're married filing jointly, do they both need to be on the Massachusetts return and the New York return? And do they have to pay taxes in both states?
Well, basically, I mean, fortunately, there is, when you're paying taxes to multiple states, if you're a resident of one, but you also have to pay taxes to a non-resident state. So for example, if you're a resident of New York State and you've received Massachusetts source income, you would have to file a Massachusetts non-resident return, pay a tax on that income. But as a resident of New York State, you would also have to report that Massachusetts income. The helpful part of this is whatever tax you pay to the state of Massachusetts, you get a credit on your New York State return so as to avoid double taxation. So that you have to always keep in mind. It's possible you may have to file two state returns, but if you've got to report that same income on both, you have the ability to get a credit for taxes paid to other, what is known as taxes paid to other jurisdictions. That way you don't get double taxed. Typically, the state that you deem to be your resident state, you report all of your income, regardless of where it's earned. Okay. So you got to keep that in mind.
Okay, all right. Will you be taxed by your previous state of residence instead of Massachusetts? So
Yeah, I mean, typically, if you've left California and you've moved to Massachusetts, and for that part year that you were a California resident, and you earned income in the state of California as a resident, you would file what would be known as a part year California resident return. So that covers that part of it. Now you're in Massachusetts, and if you have Massachusetts source income, then you would report that income on your Massachusetts return as either a resident or a non-resident, depending upon your status in terms of your place of abode, so to speak. So it would be, each would be separated, and you would file 2 part year returns.
Okay. Do students need to file quarterly taxes with the state of Massachusetts? And how do they know how much money to set aside for state taxes?
Well, for Massachusetts purposes, it's pretty simple. Massachusetts has a flat tax rate, which is 5%. So my suggestion is if any amount of income that you have to report on a Massachusetts return, 5%, if you set aside 5% and submit that at the times you need to submit it, you'd be more than covered.
Question, will Harvard provide the 1099 HC for GSAS students? I'm not familiar what a 1099 HC is, Bob.
Well, the HC form is basically, it's in Massachusetts. If you're a resident of Massachusetts, you have to have health insurance. Now, as I understand it, every student attending the university does have health insurance. And I would think that the university or the insurance carrier is going to issue to these individuals that particular form.
Yeah,
And it's just the evidence that they are during the year covered with health insurance.
And I posted a link in the chat, everyone, from the Harvard University Student Health Program with information about how you can access that.
Oh, great. Thanks, Rachel. How might having a remote part-time job in another state affect our filing process if we're a resident of that state? So I'm assuming that this person is in Massachusetts now because they're a student, or is that not the case? I don't know who posted this in the chat earlier. If you can let me know, perhaps. Yeah, so I guess they're living in Massachusetts, but having a remote job in another state. How would one file that way with that, Bob?
Well, in terms of, one of the factors involved in that is the W-2 form that is being issued by that employer. Number one, and number two is what that individual deems to be their residence state. All right. So the question is, it's again, possibly, if you're living in California for a period of time and you move to Massachusetts, typically you went from being a California resident to a Massachusetts resident. Now, it's possible that individual may still be employed by that California company, but here physically in Massachusetts. So that individual may end up getting a W-2 form that deems that income to be California source income. So my question is, that individual would have to report, I would say, a part year California resident return, and then a part year Massachusetts return. It can get complicated only because of how the employer may be treating this. So each case can be slightly different. It's not necessarily the same across the board. And now more so, you're seeing more and more of it today, where people, people are frankly, I've been told, for example, if you're in a lot of employees of Apple, from what I understand, have to other locations, out of the state of California, because it's so expensive to live in California. It might be cheaper to move to Montana or something like that. but, you know, they're still maybe deemed California residents for tax purposes.
So Bob, if I never set foot in the state of California, but I earned income from a California company, they send me a California W-2,
Yeah.
but I'm physically here in Massachusetts, I would have to file a.
Well, I would,
partial
in that
return?
instance, I would say you would file as a non-resident California non-resident.
Okay.
Pay
So
whatever
so
tax,
that's the thing. You can file as a non-resident.
sure. Pay
Okay,
the tax to California. Now, if you're a resident of Massachusetts for the entire year, that income would be reported on the Massachusetts return in full. The saving grace here is on your Massachusetts return, you would get a credit for the taxes that you paid to the state of California, thereby eliminating double taxation. So it gets confusing, and my philosophy has always been try and keep it as simple as possible, but sometimes the employer doesn't necessarily make it easy for you depending upon how they treat you for tax purposes.
Also, where do I claim the lifetime learning credit on the forms, and do we have to provide an itemized list?
Well, the lifetime learning credit within, trying to sort of be specific, there's a specific tax form, which I didn't include here, but there's a specific tax form that is attached to Form 1040 where you go through the calculation. Now, if you're using a tax software, somewhere during your process of preparing the return, you'll probably be asked about you paying tuition and fees to universities, and then the whole topic of the tax credit's going to come up. There's a specific form that you use, but when you're using, again, tax software, hold on 1 minute. Let me just quickly. See if I can, yeah, see, it's, when I say it's hidden within the return, there's a schedule that is attached to the return where the amount does come forward. So, but basically, again, when you're going through the process of inputting your data into the tax software, you'll probably be asked if you have incurred any higher educational costs, expenses in the form of tuition, et cetera, et cetera, et cetera. And you're going to respond yes. So what that's going to do is take you down a certain path where you'll get into the discussion of whether the American Opportunities Credit is available to you, or the Lifetime Learning Credit is available to you, or there's another deduction that's available to you. But it will get into that whole process to arrive at the conclusion that you either do qualify or you don't, and the credit will show up on the return.
Okay, great. I think that's all the questions we had. If I missed anyone, please post it in the chat right now. We have about 4 minutes left before Bob leaves us.
Yeah, and as always, you have my email address. Like it happens on many occasions for myself at 2 o'clock in the morning, you think of something, you can certainly email me at 2 o'clock in the morning. Of course, I'm not going to respond, but it'll be there waiting for me the next morning, and I'll be more than happy to provide a response. So again, I'm sure we'll see some subsequent inquiries, and I'd be more than happy to respond.
Great. All right, I think that's it. Nothing further has been posted.
All right.
Robert, again, thank you so much.
Thank you, Lisa, Rachel, Sarah. I appreciate the opportunity. And again, for all those who have participated, again, if you have any questions, certainly send me an email.
One quick question, just to clarify. If you're brand new students that just received their first stipend in September, do they have to pay in September?
No, if this, well, let me say this, does this stipend
Here-
start in August or September?
Well, some students start early in August, others, many others don't start until September 1st is their first
All
stipend.
right, so it's possible they may have received either 4 or 5 stipend amounts in their
It-
initial.
Yeah,
in
and
your
some
initial
students,
year.
some students start in July, depending on what area of study they're in.
Oh,
So,
okay.
but
all right.
but the ones that started in September, what
Oh,
should they do?
well, the fact of the matter is, in their case, and as I stated earlier, if you had an individual that received 5 stipend amounts, their tax liability, and if that's their only source of income, the only source of income they have is the receipt of 5 stipend amounts. Their federal tax bill is $398. Now, if you recall, if your estimated tax liability for federal purposes is under $1,000, you are not required to pay an estimated tax because you're under that threshold. So that sounds like that applies to this particular individual. So
But if they don't have any other income, yeah,
unless they have other income, if they have other income, they may be on that threshold and may be required to pay an estimated tax. But assuming this is their only income, their tax bill is going to be roughly $400. And that $400 can be paid at the time they file their return on or before April 15th of 2023.
okay.
So that's the first time they have to think about sending the government, the federal government, any money. Not only they, that's the first time they have to think about it, but for the new year, 2023, they have to begin paying estimated taxes for the 2023 tax year.
Okay, right. Where is the best resource for students to go if they want more information about quarterly tax filing? What would you suggest they do,
Well,
Bob?
again, the irs.gov website, basically, there's a search bar on the principal opening screen. When you get to irs.gov, there's a search bar, type in estimated taxes. And
Okay.
it will refer you to publications and it'll give you all of that information.
Okay, great. And if they're confused, they can
And if all else
email
fails, they can
you.
always send me an email, right?
Okay, wonderful. Okay, I think
All
that
right.
just about wraps it up, Bob. Thank
Really?
you again so much.
right. Thank you. I appreciate it. And we'll see you next Wednesday.
Thanks, Bob.
All right.
Bye-bye.
Thank you, Rachel. Thank you. Thank you, Sarah.